Hello, everyone. It's Jonathan Schachter again, coming to you on Zoom and on YouTube Live, or you may be watching this as an archival recorded on live YouTube originally. I'll kick the formal talk off at 9:05, but we have time here in the beginning to let some people come in. 9:05 being 5 minutes from 4 minutes from right now. Just to show you, I don't do quant work all the time. This is one of my two kitties. This is Mikey. We got him, let's see, in 18, and he was 2. Just getting on in his years. 8 years old, but very gentle cat. Just a regular domestic short hair. He sits right next to me here when I get some of my best ideas. Take a look onto the YouTube to see if people are chatting, talking in there. How many people we have over there? This YouTube channel here, we can, I know you can't see it. I'm not sharing my screen, but you can subscribe to it. And you can also watch these episodes in the future. They're entirely videotaped there. Among other things in this talk, I'm going to explain that these MRMDs are going to stop in, I guess it's 5 weeks. And that's right before we're submitting our MRM textbook to Academic Press, our publisher. At that point, we want to focus on just the material and whatever aspects of intellectual property are involved with that. I don't want to get into big fights, but I will be forming a new set of discussions. We'll do it at the same time at 9 o'clock New York on Wednesdays. And that will be on what I call STORM, Special Topics of Risk Management. So I've had some questions, things come up also in my own career about things. Securities lending is one example of that. And securities lending is something that the Fed does, and they make a small amount of money on it. But it's also something that a place like Bank of New York or the larger custodial banks do. They use the securities for which they're a custodian. Well, New York Fed's not a custodian, but the idea is that these securities that are around can be used by other people for borrowing. It's more common in the private markets to have borrowing of stocks, say, so that another investor can short them. I've been interested in that for a while. I worked on a project like that for BlackRock. I also see, without getting too political, that Robert Reich is out there saying that securities lending is immoral, I guess, for billionaires to do, which and that it has to do with their unrealized gains and things like that. But I'm not going to get into that. Anyway, I see that one last check. I see Greg is here unmuted. Greg Marpison. And over on the Delta Vega side, I think I'm the only watching person. All right, so why don't we kick this off? I'm going to share my desktop. Most of the things are going to be in the, let's see, this is the description of the Zoom meeting itself. Here's the talk. Most of the things are going to be in this PowerPoint, but there is, like last time, a little toy model that I did in a spreadsheet to illustrate some aspects of correlation. So, something loud here. Okay, better. Good. All right, so today is MRMD number 23, and it's the second part of portfolio model risk management. So to inspire you, here's a picture of George Soros right on the front. Right, so some of these, if you've been to these talks and seen these before, may be repetitive, but just for the sake of everyone here, the motivation for these talks was a new book, which we have forthcoming 2026 by Academic Press, which is the first textbook of its kind on model risk management, and it's made for financial engineers, in particular, ones who have newly graduated a financial engineering program, or to actually have a course like this. There are a few financial engineering courses around the country that have courses in model risk management, and of course, there should be more. Here's just some legal things saying that we're recording to live YouTube, as I explained, and those are going to be archived, and that there are minutes that are recorded. So, implied consent, you're walking into essentially a public place. All right, so there are 6 topics I'd like to cover today. The first is a review of the first MRM on portfolio risk. That was a week ago with an intervening talk that I did on Sunday for an issuer credit risk. Then I'm going to talk a little bit about equity portfolio models, which were discussed a little bit in part 1. I'm going to spend a good bit of the talk just talking about correlation, just because when it comes to portfolios, you're sort of naturally concerned about the correlations between between 2 or more assets. Then I'll talk a little bit about hedge funds. Section 5 and 6 are this kind of standard material that I put at the end of the talks. And one describes the next MRMD talk, which is going to be on CDOs, collateralized debt obligations. All right, so let's review some of the things I talked about the last portfolio risk talk, which was part 1. So that includes things like standard errors and the Sharpe ratio and relative return. So I talked quite a bit about portfolio statistics, which is using actual numbers. And the bottom line in this first paragraph here is that sample sizes, at least for a statistician, tend to be relatively small. Like someone could just look at the annual returns from a portfolio, the S&P, or a bespoke portfolio, managed portfolio of some kind. And so then you have an N of 10, so then even if you are drawing from a normal distribution, you probably will not get things that look like a normal distribution if you only draw 10 times. It's a bit better if you draw 60, which is something like monthly returns over 5 years, but it's still substantially less than say 1,000, 10,000. And what that means is that there's a sampling error, which typically goes like something like 1 over the square root of n. So the smaller n is, the larger that's going to be. In the talk last week, we did here I'll use mu to mean the mean and sigma to mean the standard deviation, and those are of annual returns or whatever returns you're looking at. So naively, you can just calculate mu and sigma, but it's better to put in these standard errors because that gives you a more realistic view of what you're looking at. Either that or take 1,000 observations. It's just hard to take 1,000 observations of returns unless you're getting down to weekly or daily returns. And then given that there are those returns, here I'm in this second paragraph in here, all these things that you've heard about, that someone can beat an index, that you can get an excess return over a risk-free rate in the CAPM, are kind of questionable when you realize that, the mean distribution is not a delta function. There's a lot of sampling error in it. On the models themselves, I mentioned CAPM before. I talked a little bit last week about pairs trading and co-integration. Well, I'm not going to cover those two. I will talk more about econometric models, and I'll do an actual fit to an econometric model for S&P 500 returns. Okay, and so then I think the main takeaway is that there were some certain things, such as beta, which were defined, that there are departures from normality simply because the distribution itself has skew and kurtosis, let's say based on daily data, so low standard errors. But it also may behoove us to look at things. By default, we look at the mean and standard deviation, and we're always thinking in terms of a normal distribution. But these three bullets here under robust statistics are usually a lot better to use. Median you should have seen before. Absolute deviation is just, instead of using a square root of the sum of squares, you're using an absolute value. So it's so-called L1. It's one-dimensional. It doesn't require squaring anything. Yeah, SCs can be large, especially when you have something like the Sharpe ratio, because there you're concerned with the quadrature sum of the relative error in both the mean and the standard deviation. Okay, and here's a homework problem to try, by the way. It basically, pick some stocks, like I suggested, the 5 FANG stocks, Facebook, Amazon, etc., and see if you pick those and then guess some weights. The simplest thing is just equal weighted. So take this portfolio and calculate its mean and standard deviation, and the Sharpe. You can do the actual Sharpe ratio, or for the purposes of this, you can just take the ratio of the mean to the standard deviation, which doesn't take out. So now it's not the excess above the risk-free rate, but it's still something useful. So you don't have to go out and get Fed funds data. And so then you can see whether you outperform the benchmark and what volatility you had relative to the benchmark and so on. Okay, so let me talk a little bit about more about equity models. So I mentioned last time that there were factor models. I just wanted to kind of go through the steps of an ordinary deriving factors. Parallel to this, one could do a principal components analysis. But the idea is that, if we have, let's say, 500 stocks in the S&P 500, then potentially, we have of order, n squared variances and covariances. And, that's a huge number to work with. So if we could boil it down to 3 or 4 factors, represented then as eigenvectors, then maybe we could do a much simpler model. We would, of course, when we diagonalize the matrix, we of course would focus on the largest of the eigenvalues. Right. I'll speak again. I said right up here in the first line that the matrix needs to be positive semi-definite, which means its determinant is non-negative, but it also means that all the eigenvalues have to be strictly non-negative. Otherwise, it's underdetermined. So I think I have most of this. The art here is what are the weights on the factors, such that the sum product of weights and eigenvectors values is equal to the predicted return, or matches the market return. Let me talk a little bit more about CAPM, and I'll give you a visual. I think I have more visuals than usual in this talk just because I felt maybe there's been too many words lately. So as we said before, it's a prediction of the return on an asset, the expected return on the left-hand side, and it's dependent on the risk-free rate, on beta, and on the market rate. So here's something new, which I didn't talk about last time, and that's a security market line, where if you imagine you're plotting return as a function of beta. Okay, return here is return above a risk-free rate. So that's a line, and then you put the actual stocks on it. In this one, I'll show you in a minute, we're putting stock tickers on that. So just to orient you, the left axis is return, the right axis, and I'm sorry there are no numbers on it, but obviously it's high at the top and low at the bottom. The bottom is beta, and it goes from 0 to about 1.7 or so. So, and then the purple line then is the risk as a function of beta. Sometimes you don't think about things, beta as a dependent variable, but this is the way the model works. So what's interesting about this is now one has a geometric interpretation in the sense that the quote unquote good stocks with high risk adjusted return are high up. The top one here at the bottom of this arrow on top is American Express. The other extreme is Microsoft here at the bottom, which at the time that this was done was not doing very well. And I should say the security line itself, as I say in the first bullet here, is based on the Dow Jones Index. Now, even though you can do nice things like that, CAPM is just a one-factor model. The only thing it's dependent on is the market, which is sometimes, just a benchmark like this in P500. So Fama and French, and that model, as I said on a prior slide, is from the 1960s. So 30 years later or so, Fama and French said that it would be better to introduce two more factors. One has to do with size, that there are distinct returns different from small caps versus large caps. And the other one has to do with book value differences or differences in the valuation between what you get without looking at markets and what you actually get kind of from a more actuarial analysis. And so then instead of just having, so the first term down here in this white box, first two terms of the capital asset pricing model, sorry about that, and then the SMB and HML are the additional two terms. And that's become popular just because we can explain quite a bit more of the observed returns with Fama French than with CAPM. Now, at the heart of all these discussions is something like a benchmark. CAPM doesn't call it that, it calls it the market portfolio. And the idea is that you can measure performance of an asset relative to, here the important words are in yellow, a large, liquid, diversified, macro representative portfolio. So it has to be large enough so that it diversifies away the idiosyncratic or firm-specific risk, which is, in essence of the CAPM model, that you're really only paid for chasing systematic risk. That in other words, for the risk that's in the market. And of course, it needs to be liquid, so it can't be manipulated. However, as I explained in number 21, most money managers can't beat these benchmarks. Now, one would think that they would therefore try a different investing strategy or just decide that benchmarks are better. and abandon the whole idea of doing this kind of active investing. Sorry. Instead, what is it? If the mountain will not come to Muhammad, then Muhammad will go to the mountain. So basically what they're doing is they'll create a benchmark that makes their portfolio strategy look good. I mean, literally, that's what a custom benchmark is. You can also work with a client to do something like that. And it could be something like overweighting certain companies in the S&P 500. But the point is, at the end of the day, that the thing that you're doing is not any of these things. It may still be large and it may be somewhat market representative, but it may not necessarily be liquid, and so on. So that's why this book, Lies, Damn Lies, and Performance Benchmarks, came out in 2022. References at the bottom. All right, so correlation, as I said, I want to spend quite a bit of time on this. Linear correlation first, non-parametric, and Excel to compare the two. Then the three next ones down here on the preview, ACF, PACF, and CCF, are all econometrics. And finally, base correlation is also about portfolios, but it's about securitized portfolios, specifically in credit, like a CDO. Okay, so I want to distinguish between what I call spatial and temporal correlation. So spatial correlation is just whatever. It's just, you have two X and Y values, let's say 10 or 20 data points, and I'm going to use R for the correlation because R squared is, well, R squared, we're familiar with it. So Pearson assumes that two variables are linearly related. So it's sometimes called linear correlation. And it comes directly out of linear regression. In fact, the square of Pearson correlation is literally the percentage of data that's explained by the regression model. Unfortunately, many of the things we see are not linear. They don't have to be polynomial, but but they may be some other function like a call, the convex part of a call function or whatever, an exponential function, say. So we can still do something if X and Y are monotonically related. Essentially, X is going up when Y goes up. And there have been two approaches that have done this monotonic. So I've seen some people say this is nonlinear correlation coefficients. Well, I guess technically that's true, but it sort of sounds like you need a special one for X squared, X cubed, and so on. These two will work for anything as long as it's monotonic. They just have some additional requirements. The one by Mr. Spearman is called rank correlation and assumes that you can create ranks of your data. So let's say integer numbers corresponding to 1 for the lowest rank, 2 for the highest, or 1 could be the highest, whatever, but just, a consistent and ordered scheme. Yeah, so that means that something like order statistics have to exist. The data has to be sufficiently spread out so you can rank it. And then there's also what's called concordant discordant correlation. In this case, we don't need ranking, but we need to be able to determine whether for any two I and J with I less than J, whether those 2 points are concordant or discordant. So concordant means that if, it's that Y moves in the same direction as X, right? So if Xi is greater than Xj, then you have to have Yi greater than Yj, and vice versa. Otherwise, it's counted as discordant. So if you decompose into those two, then in a non-parametric manner, you can get correlation. Right, so now I want to go to, if I escape out of this for a minute, and then let me put up my spreadsheet. So here is a spreadsheet with a lot of stuff in it, but I think I can break it down. So as with an example last week, I always like to add some noise to anything to make it look like real data. So this basically is the equivalent of, I believe it's 10 years. Yeah, these are 10 fictitious years. For each year, I'm drawing a random variable every time I hit F9. And then I'm going to plot some very simple functions. So the X variable is just simply running from 1 to 10. And then the Y variable is when it says Y equals X, if you look at the formula, you can see that I'm also adding in the noise. So that's why it doesn't look exactly like, 1, 2, 3, 4, 5. And depending on the size of the noise, it can be a lot bigger, a lot smaller. That's the first example. And then I took some more complex example. So this is linear and also monotonic, right? Now, a parabola, if you define it right, can also be monotonic. Obviously, if it goes through its minimum, it's not. But this one you can basically. So I set these other 4 functions up with free parameters. So when it says C1, that means this number up here can be modified. And I'll put the spreadsheet online so you can play with it. C2 means that the number 5 can be manipulated and so on. But basically, this is a parabola, an exponential function, a convex function like a call option, and a periodic function like sine. Now, the last one, sine, if you just want to look here for a minute, in most cases, it's of course not monotonic. You could play with the period, you can play with this variable, and then kind of make it the first, from 0 to pi over 2 of the first 90 degrees of a sine function might look monotonic, but that's not what I wanted. Anyway, so for each of these, I'm calculating, I'm including noise, adding that to the value of the function. So here's e to the x, and here's the call option, and here's the sine. So what do I calculate for each of these? Well, so this line here, 14, is the linear or Pearson correlation, right? So, for example, they all look okay to first order, except the 20% for sine, and that's, as I said, because it's a pathological type function. Then here's the rank correlation, which basically you can see what's done here. You're basically ranking the data points down here, like this is an Excel formula, just to get the rank of a particular data point in the array. And so then, with rank, you're basically just correlating. So for Pearson, I'm correlating X and Y, say. For the rank one, it's going to move every time I hit. So it's just refreshing the random variable. So for the rank correlation one, I'm correlating, again, this is obviously it's 1 to 10, but the ranks here are somewhat different. And so the correlation of those two is the Pearson. So let's see. So there are a couple of things here. Oh yeah, and this line here I'll show on another slide, but there is a shortcut for calculating rank correlation if the data are well behaved enough. So you don't have to go through this ordering process. Right. So then what's pink, what's green? So green is the difference between when rank correlation has a higher number than Pearson. Right. And pink just means I think it's a number that's less than 95. Maybe it's the number has to be greater than 95, otherwise it's pink. So I guess there must be rounding between these two. Maybe it's, yeah, let me just do that. Add a decimal point so I don't lose my mind. Okay, yeah. So anything 90.0 or greater will be blank, otherwise it'll be red, suggesting that it may not be a good correlation. All right, so then what you can do with this is you can just repeatedly hit F9 and see what happens to these values. So generally speaking, I think you tend to see things like this, where rank is doing a better job than Pearson. In particular for this exponential one, the Pearson one is less than 95%, whereas the rank is greater than 95%. So it's an 8% difference. So I think what this is showing is that in most cases, you're better off with Pearson, without Pearson and with rank instead. On the right, I'm not showing correlation, but I'm showing you the actual data points. So for example, the one that sticks out on top is this parabola, and I played with it a little bit to get it to really kind of stand out from the other ones. The sine function is obvious. And the other ones, because of the range that we've picked here, look relatively linear. That would be the linear one itself, the exponential, and the call option. So again, this is just something that to give you an idea of the edge that you might have. The lesson here is not to use it for things that are not monotonic, but that in general, rank correlation is going to be more robust in the same way that a median is more robust than a mean. All right, so let me go back to the talk. And as I said, I'll put the spreadsheet up. Yeah, so let's see, did I miss anything? These are just the functions that I said. This is the definition. Yeah, looks like I said everything here. Okay, and so then this is just for completeness, the Spearman closed form. So basically, if you have data so that you can rank things in integers, that means you don't have any ties. If you have a tie between 1 and 2, you would have to say 1.5 between two ranks. So anyway, this is a handy little formula that that D is the calculated thing here. Is these are the differences in pairs. Or rather the difference between the X and the Y value, the ith values. Okay, now I said a little bit about this last time, I think, but most of the correlations that we see are not really observable. We're basically, we're taking returns and we're calculating the correlation today from historical data, but that in no way will predict what correlation will be in the future. And it may not be stable. It's also known it's very dependent on what the frequency is of observations, daily, monthly, weekly, yearly, and on the time interval that's chosen. Right. So in other words, that these correlation series are non-stationary and neither are the correlations that you derive from them. So we don't really have a model. The second set here, except for CDO-based correlation, like if you have Black-Scholes, implied vol is not observable in the stock, but it's observable in the prices of vanilla options. So other than CDO-based correlation, you can't really see correlation in a market-traded object. You can't say, here's a stochastic PDE, as we might write for, let's say, interest rates. So this is a normal process here, but that has a time and then it has a Wiener, or if you like, Brownian motion component to it. But we don't have anything like that. We don't have any way to observe correlation or the volatility of correlation or anything like that. And this is just the mechanics about how to get the correlation matrix. Okay, so now let's move a little bit more into econometrics. So here, we're not in the spatial domain. Now we're in things where there's a time series. So let's suppose that we have stationary time series throughout this discussion. That means it's not drifting off something, like you subtracted the mean or you've done a regression and removed that. So it's fluctuations around the mean. So then the cross-correlation function is essentially the cross-covariance, which is from sliding y, t, and xt, divided by those variances. So it's defined in the same way as an ordinary correlation is defined let's say, the Pearson correlations we were looking at before. It's not used that much. I've used it sort of in comparing different series and establishing what series could be used for VAR. The fact that two things cross-correlate is sometimes useful. What's more useful is autocorrelation, which is, the correlation now that we have a time series between something and a future time point. Or in general, it's the correlation between something and all possible time points. Think of this mostly here as in the time domain of time series. So that means we're not talking about high frequency or low latency trading. We're just talking about like daily data. So a lag of 1 means yesterday. So the autocorrelation function is showing at each lag, 1, 2, 3, 4, 5, is there some correlation? If there's zero autocorrelation, then you'll just have a spike at lag 0, which is today. But if there are other ones, the lags will then be less than 1 by definition, and they'll show then some autocorrelation. Okay, so for example, let's see. Let's move my notes. So here's an example of a time series and its autocorrelation. And so, it's sort of hard to look at X and T and pick that out, but you can see that there's some structure. So the autocorrelation function, again, is a number between -1 and 1, like ordinary correlation. And the horizontal axis is showing the lag in days. All right, so you can see, so there are, although the central peak is still at, just trying to move the mouse around, get it over there. Can't see the mouse. There we go. Close to 1. Some of these like lag 2, lag 4, and so on are significant, and some of them are negative. You can have negative autocorrelation just like you can have negative correlation. The significance of these things, as I'll show later, well, I think this just from the standard error discussion, is just going to be 1 over the square root of m. So, and here there are something like 100 data points, so it's going to be, 0.1. So that means that some of these very small ones are probably not significant, but this one, it looks like it's twice the standard error, and this is maybe 1.5, so they might be believable. So one way to tell if it's autocorrelated is to do this. Another one is that there are specific tests that one can do and say, is there significant correlation in the statistical sense? Can you null the hypothesis that there's no autocorrelation? And Durbin-Watson is the most well-known of that. It only tests one thing. It only tests whether today and yesterday are autocorrelated, but it's still useful. If you want to know about all lags, then you can run a Brush-Pagan test, and that will tell you which lags have statistically significant autocorrelation and which don't. Sorry. So, bit of a word salad. Okay. Yeah, so that's autocorrelation. Now, there's also something called partial autocorrelation. Autocorrelation is, the effect of the next, of essentially all the lags, whereas partial autocorrelation function is, let's just look at one specific lag and not include the ones in between. So this K prime here might be 5 in the case of a partial autocorrelation function, which means it's really only doing 5. It's excluding 1, 2, 3, and 4 as logs. And part of this exercise is because what we want to do is find out, of course, the underlying econometric model, which I haven't gotten to yet, but that is what's going to identify the structure in the time series by, what are the lags that today is most closely connected to, and therefore those would be the best predictors of today. Right. So let me introduce the 2 canonical type of econometric models that you're most likely to see. One of them is called an autoregressive model. And you can see here that the value at t is then represented as a linear combination of past values. So the first term would be xt minus 1, the next xt minus 2, and so on. And then the phi's here are just coefficients. And the epsilons are mild friend, the normal distribution draws. So for instance, if we just let I equals 1, then it's just one term. So today is based on noise plus some number like 0.8 times yesterday. And as with something like EWMA, the value of that coefficient is going to determine how strong things in the past are. Okay, but right now, if it's just AR1, that's just a 1 day ahead prediction. And the other one that's common is essentially an averaging. It's something that's forced to be mean reverting, and that is a moving average or MA model. So I use here just a y instead of x for variety, as a theta instead of phi. But then instead of looking at prior instances of y, you can see it's independent of that. So there is no autoregression here, but instead it's a sum of noise terms. So these themselves are the draws from the normal distribution at different lags. So that's where the noise terms are. And then the add-on here is not the noise term, but it's the actual mean that you want to revert to. Again, the simplest one is just to let j equal 1. Now, I mentioned before that partial and total autocorrelation functions are important to try to figure out what it does. So basically, the main point of this is that a partial autocorrelation function for an AR process is cuts off right around lag of what identifies the process, the order of the process. So this is an AR3 process here. So it's, as before, lags in the value of this function. But here now we've got the dashed line showing the balance. So that's the 1 over square root of n. Therefore, the only significant lags go out to about 3. And that's why this is noted as an AR3 process. There's some more on here, but I think I want to speed up a little bit. Let's take some actual data. So a recent paper calculated the autocorrelation function for the S&P 500 for a period of 11 years and did it at lags 1 through 10. So that's what's presented here. So it's a lot of numbers, do any of them mean anything? Well, we know that the significant, this should be 1 over the square root of 11. With 11 years, then we know the standard error is about 0.3 plus or minus. So then we can look in here to the autocorrelation values and see if anything is greater than that standard error. The green, and it turns out it only happens in 2020. More about that in a minute. And it only happens significantly strictly for lags 1, 7, and 9. You can see that these cases are borderline with 0.28. It's pretty close to 0.3. So that's, one of the things about having just a small number of years. But we could call the yellow ones borderline. Anyway, so you can see though that if I look at this, I would say that lags 1, 7, and 9 are the ones to build the model from. And that's exactly what I've done here, that I've simplified the summation before, and I've said that we have a 1 lag term with its own coefficient, a 7-day lag, and a 9-day lag. as another exercise, one could also compute the PACF for that because there may be an MA model that is part of this. And I went through it kind of quickly, but there is a slide where I mentioned RMA, which is an autoregressive model that is pasted onto a moving average model. And that gives you kind of the best of both worlds and adds some noise. All right, so I did 5 regressions of the lag data. And generally speaking, even though I used adjusted R squared, the adjusted R squared increased with the number of predictor variables. All right. Having said that, the largest R squared that was observed was, a little bit more than 20%. And that's using all 3 lags. So none of these are great fits. I'll return to that later, but let's just assume for the moment that this is right. It's also interesting to see that the larger ACF values in absolute value are the ones that drive the R squareds. There's a relation between those. High significance in the ACF means a high contribution, a good R squared for the total model. All right, so here are the 3 coefficients that were observed. And so, the noise term can be added on to this. You can see they're all about 0.2 in absolute value. And then I did this in Excel. I guess this calculates the standard error. So that's another thing that, these coefficients are this one's only about 3 times the standard error. This is only 4 times. So, I don't know. It's debatable whether this fit is the best thing. Yeah, and then this is just a comparison of the moment matching between the data and the model. You see, generally speaking, that the model has underestimated the risk. If you look at that from the standpoint of standard deviation or the mean absolute deviation, it's about a factor of 2. And so, maybe throwing out those other lags, which were 2, 6, and 8, the ones which were not statistically significant, maybe if we put in 1 or 2 of those, then that would enable us to see some more risk. Graphically, these are the returns over time. Orange is the fit and blue is the model. Now, clearly, with COVID in March of 2020, the data were crazy. And the model, can't really get that in the standard deviation. But, generally it looks good. What I remember from my career in astrophysics is it's also useful to take the residual, which is simply y minus y fit, and plot it on the same x-axis. And that's what this is. So these are residuals in percents. So this is, the different return. This would mean that, here, this data point is 10% higher in the actual model than in the fit. And these are almost 10% lower. So, there's definitely a lot of noise over here. But other than in March of 2020, there's not a whole lot of structure over time here. So that's a good sign. Let's see. As far as CDOs, I guess I did this in a fairly detailed way, but I want to make sure I still have a little bit of time to do hedge funds. Let me just say that what this page is about is how last week we talked about issuer credit risk, and we talked about a capital structure in the case of bankruptcy. So CDOs also have a capital structure. They have senior, mezzanine, junior. I guess there's some variations like super senior, senior mezzanine, junior mezzanine. Anyway, and then there's equity. Equity is at the bottom and the riskiest. So, if you have a low tolerance for risk, but you're okay with low return, then you can invest in the higher tranches. So I mentioned here about a mortgage back. I can talk about that some other time, but just to focus on the CDO, it goes something like this. So in a mortgage-backed security, the the first principal and interest payments go to the most senior tranche, right? And then as time goes by, ideally you would get all the promised principal and interest payments, but of course there's prepayment. We're a mobile country, people move to different parts of the country. So if you have the equity tranche, the lowest, most junior tranche of a mortgage pool, then you're probably not going to get anything. CDOs are kind of that upside down. The equity is still the most riskiest, but what happens is it gets eliminated first in the sense that your payments end when companies, when the first, whatever percentage of companies default. Every time one of those defaults, you get less and less until you're completely extinguished. And then, so this is basically saying the first 10% of defaults will wipe out the equity tranche. The next 10 to 50% will do that. The red lines are just to show you that there's no overlap, that they're just adjacent to each other. There's some intuition in the correlation here that I guess a lot of us started thinking about when CDOs came out. But to make a long story short, in the ideal case, the most senior tranche would be short correlation. It's unlikely to default anyway. So the only reason everything in the senior tranche is going to be wiped off is really bad economic times, when times are difficult and when correlation is like 100%. The equity tranche at the other end is going to be wiped out pretty much no matter what. So the only thing you can hope for is for a high correlation and good economic times. So that shows that it's long correlation. And these are, heuristic, intuitive arguments. In general, if one looks at the correlation in a particular tranche, one gets a non-monotonic function. So this is what it looked like. And this is essentially where one would calculate the correlation within each of these tranches. So you'd like to see it increase or decrease monotonically, but it doesn't. This is sometimes called compound correlation. And what's plotted here is for two different standard indices that track CDOs. Now, what was realized, though, is that instead of looking at the correlation between the two attachment points in each tranche, one should reference everything to the base, to 0%. So the equity tranche is always referenced to the base anyway. But in the case of the junior mezz, you go from 0 to whatever the top of the junior is. I think I said 10, whatever I said, I can't remember. I'm not going to go back to it, but so in that case, you're including more and more, and therefore you're guaranteed to have monotonic dependence. That's it on CDOs. The next time I'll talk the whole hour about them and how you do base correlation. There's also recovery, which we didn't talk about, a number of things. All right, so I'm going to talk about hedge funds for maybe 3 minutes and leave 3 minutes for talking. So basically, this is just a chart from CFA Institute. They run the CFA test. So it's basically explaining different kinds of strategies, distress strategies, volatility trading, things like that. And I'm not really going to be able to get into all of this. Hedge funds themselves are pretty non-transparent, so you don't really know what's behind the scenes anyway. The ones that I'll talk about for a slide or two are a long short and one that's essentially all short or nearly all short. So it is useful to define some parameters here. L is the amount that's in the short. L is the amount that's in the long. S is the amount in the short. And then the gross is just, so then you can talk about the gross and the difference. So then you can calculate these four things. The net and the gross. and then 2 ratios of long and short to gross. These are some of the values. You can see that, 70 to 90% is what a typical long short strategy would have on the long side, and correspondingly the short would be the complement of that. If it's really a dedicated short, you can actually get more than 100% short. And what does that mean? That's because you're borrowing, so you can leverage up. I'll say that this is a little bit of a snarky remark, but there's a better way to calculate these things, and that's by differencing these two things, which were called the long-term and the short-term ratios. Then you have something just a little more elegant. All right, and I'm conscious of the time. So yeah, so the rest of the material, I think I just wanted to spotlight that there is a CDO talk next week. It'll include some of my own work on bespoke tranches when working in Lehman after it was bankrupt. There is a new thing that I'm floating here. Basically, on December 1st, we'll stop talking about the book, because at that point, we'll have submitted some of the intellectual property of the book to the publisher. Then I'm going to shift to what I call STORM, which is special topics in risk management, some of which are model risk management, but there are other ones like securities lending, for instance, is a fairly interesting topic to risk manage. And I'm planning to create a discussion group for the special topics on LinkedIn. This is a description of what my single person company is, and offering assistance if you'd like to try to be a consultant. Do note that next week, the 30th, London will be at 1 p.m. It'll only be 4 hours different, because it's changing its clocks this Sunday, the 27th. But when we get to Wednesday, November 6th, I guess the day after the election, that's going to be back to the 5 hours that we've had. We are on EDT now, Eastern Daylight Time. We are going on to Eastern Standard Time. The UK is about to go from its summertime to its winter time, which is just the ordinary Greenwich mean. And just some things on how to contact me. All right, so let me do that. Let me put up find the chat window for YouTube. See if anyone's in there. I don't see chats in there. So if anyone wants to chat, sounds like many people may be consuming this when it's recorded. So, you can definitely use the email that I have up here to get in touch with me and ask questions. Oh, and I wanted to highlight that I do have a QR code here if you want to quickly connect to me on LinkedIn. I just keep moving around, but basically this is the QR code.
Yeah, can I ask a quick one?
Yeah, we have a couple minutes for questions. Go ahead.
Okay, so around slide 27, capital TS, what does that stand for?
Capital what?
The abbreviation T capital S on slide 27.
Time series.
Okay.
Yeah, I think that's I think I defined that somewhere. I usually do. I guess I did not. I usually define it as anything, but yeah. Yeah, a little background noise.
Yeah, sorry, I'm in a.
No, that's fine. Other questions or yeah?
I did, but maybe I have to ask them by when you refer to call option in the rank correlation, the call option profile, can you remember that slide?
Yeah, I can put that there.
Why did you call it call option? Can you just relate that intuitively?
Why did I call it a call?
Well, you referred to call option as like the characteristic
Yeah,
of the profile.
Yeah, it's just using a max of it's this. So it's the max of
Can you show it?
as a formula, yeah.
I just can't see your screen.
Oh, I thought I should share it, didn't I? Maybe not. I know I shared and then I did not hit share. Okay, there we go. All right. Yeah, so you should be able to see this.
Okay, so column F
So
has got a 5.
yeah,
5
that's
refers to the,
C3. That's this. That's the strike, I guess, strike price in this case. So it
Y
includes,
equals max.
that's just the definition of a call option of strike of on stock X struck at C3.
Okay, that helps. What does, what does row 3 represent? Row 2, what's that number, like 0.5? Again, what is that? 5,
It's just the
10?
C1, C2, C3, C4. I guess if I were more clever, like D2 is added on to the I guess it said minus C1.
Because
Yeah.
this is this is still auto regression.
No, this was an example of in the spatial domain. This is comparing
Okay.
Pearson and rank correlation. Yeah.
Pearson rank, okay.
Yeah. I did do
But
the
what are the values like 0, 5, 5, 10? What do those mean? What are
where?
those? Row 2.
Yeah, as I said, those are just the coefficients C1, C2, C3, and C4.
Okay, so
So,
C1 doesn't refer to a cell, it refers to something else.
right, it's a constant. I could also
Okay.
call it C, D, F, G. Yeah, that's true. It looks like an Excel address. You're right.
Okay. I understand that. Okay, so I'll go back over the slides and then try to put it together with the intuition of these formulas. Thank you.
Sure. Yeah. I mean, it's basically just the ranks. Yeah. The I was actually surprised. I thought that rank would do a lot better than Pearson, especially for these funky things. I mean, not for the non-monotonic one. I thought for sure that for a quadratic or for an exponential, that there'd be a substantial difference.
Mhm,
And yet, maybe I have to have many more points, but
mhm.
it just, just having a couple of percent difference between the two. I mean, that's not, it really
Mhm.
always makes it sound like, oh, you can't use linear correlation, you have to use rank correlation. But I mean, well, this is these cases where it's like less than 90% or something, where there is a significant difference. Then you can
Okay.
say you can use rank. But since it's not happening all the time, at least in this numerical experiment, I'm gonna have this Excel. I'll put this Excel on the
Yeah, I can learn a lot just from the choices you made about exponential, max, and then sine. That's brilliant. Thank you.
yeah, I mean you can copy
Linear
the spreadsheet.
exponential max is fine.
Right, you can copy the spreadsheet and reverse engineer it and make it better sense. But I will put this up. When I get the minutes, I'll put the minutes up, I'll put the slides up, and I'll put this Excel up.
But that combination of recalculate the data visually and then represent the correlation values on the
Right.
left, so you can see both on the recalc is a teachable.
Yeah,
Cool.
this took a while, as you would expect, this took a while, but I enjoyed
Wow.
doing it. The graphs I did at the end, but
I've never seen anything like this. And then the base correlation, thanks for referring that, the base is to the base of the prompt.
right.
I have to remember that.
Yeah, on that one, right. And then
Because it sounds like an abstract concept, but it's not.
no, it's not that difficult. What was difficult is when we had those, non uh monotonic functions and people saying, well, maybe the equity and the senior are limiting cases, but we don't really know what's happening in the beginning. I think there are basically two solutions.
Oh.
And so that's why it can go either way. But yeah, that was definitely a conundrum.
Super senior and equity in limiting cases. Okay.
Right. It was just difficult if you're trading correlation, if you're a bank, or if you were an investor and you wanted to take a position in correlation. When something's non-monotonic, you don't know what's going to happen if the market moves. So,
Thanks very much, Jonathan.
yeah, that's fine. I hear the background. All right. Yeah, just reach out to me. I think I'm just going to take a break.
I will. Okay.
Talk to you
Excellent.
later. Okay, I'll stop the share.